Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. In this video, we're going to talk about selling weekly options versus selling monthly options. I tend to think that selling monthly options is better and you'll make more money in the long run than selling weekly options. But if you just look at the premium, selling a weekly option 6 times in a row or 4 times in a row or whatever your time frame is, and you compare that to selling a monthly option 6 weeks out or a month out or whatever, you're gonna make more money in premium selling those weekly options once a week versus that one other monthly contract. On my last video about selling options on the wheel, another YouTuber left a comment as Bassem Zahili, finance, investing, and real estate. He left a comment that said, hey, I can make a lot more money selling 6 weekly contracts versus selling one monthly or one contract 45 days to expiration. So what am I missing here? I'm like, oh, that's a really good point. So I need to make a video about that and kind of sort this out so it's kind of clear why I think. And I think that the data, the studies and stuff show that monthly options, outperform weekly options. But if you're new to the channel, I'm Justin and I like to talk about financial independence, dividend investing, and building wealth, and document my own journey towards financial independence and building wealth. So really appreciate it if you like this video and subscribe to the channel, all right? Quick disclaimer. I think the best resources on YouTube for learning about investing and selling options are TastyTrade and Option Alpha. And they have all this research and they have all this data of all the option history, and they do this back testing where they can look at all, different strategies and how they perform and how many make money and how many lose, and they do a much better job of going into the details of how weekly options and monthly options, how they perform versus each other. So I'm going to leave a comment down, or I'm going to leave the links to a couple of those videos in the comment section that you can look at there, and they go into really good explanation and details on how different strategies, all things being equal, the monthly contracts outperform weekly contracts. Now, the difference between a monthly contract and a weekly contract, monthly contracts are, they expire on the 3rd Friday of every month. And you can buy them for like September, October, November, and some of them have them really far out, like in 2021 and 2022. And those are your general standard option contracts. And weekly option contracts, they expire on every Friday, except for the difference is they're only created on the Thursday before. So they have a lifespan of only 8 days. The benefits of monthly contracts are that most tickers, most securities have some sort of monthly contract associated with it. And you can buy these for a lot of different tickers, and they also have more liquidity. Not all tickers have weekly contracts. They are less volatile than weekly contracts because they have time value associated with the contract, the option's price. The longer a stock option has to expire means it has more time value. And that time value reduces the volatility in your option's price. If you still have 6 months for an option to expire, just because it goes in the money or out of the money now, there's a lot of time value associated with that, and the price won't be as volatile because things can change. Just because it goes in the money, it can still go out of the money later. Now, a weekly option has very little time value, so those differences in the stock price affect a weekly contract much more. Benefits of weekly options are that you get paid weekly, and that's a really cool feeling, is making money every week. You won't have to hold the contract over the weekend because you'll buy it on like Monday and it'll close out on Friday. So like the Fed and people like that, they like to make these big announcements on Fridays after the markets close if it's going to be a volatile, if the market's going to react negatively to this information or this news. Weeklies are less liquid than monthly contracts, so you might have a wider bid and ask spread, and not all tickers have weekly contracts. So those are kind of downsides to weekly contracts, but they do offer more money. You do get more premium for selling a weekly contract on a weekly basis than you would selling a monthly contract 45 days to expiration. But with this higher reward comes extra risk too. So right now, if I wanted to sell puts on triple Q, Qs are trading at $293.53. If I wanted to sell an at-the-money put for $29.50, I could sell that the weekly expiring on Friday. That would be in 5 days, and I'd receive $391 in premium for that. That would give me a instant return of 1.3% or 122% annualized. If I wanted to sell the same put 45 days to expiration, that'd be a $292 strike price. On October 16th, I'd receive $1,286. That'd be 4.4% instant return, but only 35% annualized. So I get a little bit more money now, but I have to have my money tied up for a little longer, and on an annual basis, it's a much lower price, a lot less premium I'm getting. Now the weekly for the 30 delta is higher too. So my 30 delta strike price would be $287.50. That would get me $212 in premium, 66% return annualized. And my 30 delta for my monthly contract, 45 days to expiration, would be, the strike price would be $276, and that would get me $757 in premium, or 21% annualized. So premium-wise, I'm definitely getting more money selling weekly options. But all these contracts are not going to expire worthless. Some of them are going to go in the money. And with weeklies, you don't have time for this stock to work its way back out of the money. And you have less time to make a good decision on whether you want to roll it or buy to close or what you want to do. Another big thing, I think, is cost basis. So if you sell our same 30 delta triple Qs for 45 days out, our premium of $212 is going to bring our cost basis down to $285. But with our 45 days to expiration, our premium of $756 is going to lower our cost basis to $270.25. And I think this is a big reason why monthlies outperform weeklies, is because when it does fall, it has to fall a lot lower for you to lose money on this contract than a weekly, because your cost basis is so much lower. Now the CBOE has indexes on these, and we can compare monthly to weekly contracts. They have put, which is selling a put contract at the money on a monthly basis, and they have W put, which is selling puts on a weekly basis. Now here are the CBOE indexes for put and W put, and the data goes from 2007 to today. And the only thing that's different in these two indexes is that put is monthly contracts and W put is weekly contracts, and they're both on the S&P 500. So put outperforms 88% versus W put, the weeklies, at 58%. And they also have the same thing on the Russell 2000, monthly puts and weekly puts. This data goes back to 2011, and our monthly puts outperform 50%, while our weekly puts actually lose money, are negative 9% on the Russell 2000. You can find some good research papers on the CBOE website about how options perform and comparing different strategies and things like that. And here's a research paper that compares the performance of weekly and monthly options. It's an analysis of index option writing with monthly and weekly rollover, published in 2016 by Oleg Bondarenko, University of Illinois at Chicago. And first off, they do make sure, weekly puts do make a lot more money in premium. On average, from 2006 to 2015, you would make 24% selling monthly puts on the S&P 500, but you'd make 40% in premium selling weekly puts on the S&P 500, and you'd make 15.2% more annually selling weekly puts. Here's a little chart comparing, little bar chart comparing the put premium between the two for 2006 to 2015. But there's more than just premium, because like I said, some of these do go in the money, and you do lose money occasionally with selling options. When the underlyings go down, or we have a bear market like we did, in 2008 and 2009, or like we just got through in 2020, they showed the drawdowns comparing put, W put, and the S&P 500. Put is the green, W put is the red, and the S&P 500 is the blue. And max drawdown for put, which the monthly options, is 32%. The max drawdown for the weekly options is 24%, and the max drawdown for the S&P 500 is 50%. And this is through 2008 and 2009. But when we add all that stuff together, the performance and the drawdowns and the premium, the value of put outperforms W put again in this study, where if you put $1 into put, you'd have $1.88 at the beginning of 2016, and $1 into the weekly put, you'd have $1.72. So again, monthly contracts outperform. Our compound return would be 6.59% for our monthly contracts, 5.6% for our weekly contracts, and then the S&P 500 returned 7% during this time frame. But you see that put outperforms weekly put. So I hope this clears things up with the difference between selling weekly contracts and monthly contracts. I think that you should really go take a look at those videos that TastyTrade does and Option Alpha, because they can go into different option strategies and break it down on win-loss and profit and loss and the statistics between the two and how they both perform compared to weekly and monthly contracts. But I think I'll wrap this video up now. I think that's good. I think I got the point across, and hope you get something out of this video. Hope you like the video. Subscribe to the channel. Leave a comment down below with what you think, and I'll see you in the next video, okay?